You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 9th of March 2024, and I'm joined today by my co-host, John McEwen. In this week's episode, we'll be discussing primary health properties, Rightmove, Haleon, Tritax Big Box REIT, Reckitt Benckiser, and our US company of the week is Etsy. John, do you want to start us off with primary health properties?
Yeah, so it's one that we haven't covered for a while, but it's a FTSE 250 listed REIT, which specialises, as in the name, primary health properties, so largely GP surgeries in the UK and in the Republic of Ireland. They had their full year results out, with full year net rental income rising 5.5% to £149.3 million. And rent reviews contributed 4 million in additional rent over the year, with smaller contribution coming from extensions and refurbishments. Underlying profit rose 2.3% to £90.7 million. The value of investment property fell by 1.9% to £2.8 billion due to rising yields. With only one development underway, exposure to higher build costs is more limited. Occupancy was at 99.3% at the year end. And net debt was broadly flat at £1.3 billion, with a loan to value of 47%, targeting between 40 and 50%. On the 23rd of February, the first quarterly interim dividend was declared at 1.725 pence, which was up 3%. In the near future, growth is set to be focused on developing the existing portfolio, and Ireland is the preferred area for future investment, with ambitions to grow the portfolio to 15% of total assets, and it currently represents about 9%. And the shares were pretty flat in early trading. In terms of valuation, primary health properties has a market cap of £1.22 billion and trades at a forward price to book of 0.98 compared with a 10-year average of 1.17, and it has a prospective dividend yield of 7.7%. I thought these results were fair, and I think it is a very defensive REIT on what is a longer-term structural growth trend with increasing demand for primary healthcare in the UK on the background of an ageing population. Defensive in the sense that the rent is almost entirely underwritten by the government, and certainly that applies for the UK sector. I think there are some short-term difficulties which have been reflected in the share price, which is well down from peaking a few years ago. And a lot of that due to the higher interest rate environment, when the group had traditionally grown on the background of borrowing cheaply, securing long-term leases, and then hiking the rent according to the semi-regular rent reviews. And that model has been disrupted as money's become increasingly expensive to borrow. That being said, it does sound as though Labour plan to continue to invest and underwrite the profits at primary health properties, as GPs are increasingly less likely to want to own, build and maintain their surgeries. So I think it is, in the longer term, still looking positive for primary health properties. It was very shaky, or I was certainly shaky about primary health properties when you had the prospect of Labour under Jeremy Corbyn, and there was talk about sort of nationalising exactly this sort of thing. But Keir Starmer certainly sounds, and I guess Wes Streeting sound much more comfortable with this type of model for healthcare. So that's very reassuring, given that it is primarily focused in the UK and obviously planning to expand a bit more in Ireland. I suppose some things that would put me off a little bit is just the fact that on gilt, with gilt yields now, you're getting a fairly decent return and essentially taking no risk. And obviously there is no capital gains on gilts either. So how much growth there is in primary health properties, I suppose in the longer term, as I said, there is some, but it becomes relatively less appealing, perhaps with the UK gilt market as it is. And, that would be one reason why I wouldn't really be looking into it that much further. But I think it's an interesting group. The other comparable or the other competitor that's listed on the FTSE is Assura, which again we've covered, but not for a while. So I think it would be interesting to cover that again soon and just see how that's doing comparatively. Sam, what are your thoughts on primary health properties and these full year results?
I thought the results were all right. Last time we thought the debt was too high. The debt has technically gotten higher because the property values have fallen, whilst the debt hasn't. So as the loan to value's gone up, it's 47%, which is at the upper end of their target. It's quite high for the industry. Underlying profits of 90 million, net debt of 1.3 billion. I just think it's too high. And I know a lot of it's going to be long term and it's not coming up for renewal that quickly, but I just wouldn't touch it because it's just too high. It puts me off massively, that, I think.
Yeah.
Yeah.
No, fair enough. And I suppose it also, in terms of long-term interest rates, it doesn't look, and no one has a crystal ball, but it doesn't look like you're going back to the post 2008 and what we'd experienced the past 15 years.
Yeah, and it's like you say, you can get, I know the yield's gone up as well, but it's like a 7.7% yield. But that's for something with quite high debt. So you do question the sustainability, and you can get 4 or 5% in a bank anyway.
Yeah.
I wouldn't expect you're going to get loads of capital growth with this either. Could be wrong on that, but yeah, it's just not for me.
Fair enough. Okay, on to a stock that we both like.
Yes, and both own Rightmove. So they have come out with their full year results, and revenue was up 10% to 364 million. Operating profit was up 7% to 258 million. Underlying operating profit was up 8% to 264 million. Final dividend was up 10% to 5.7p. Total dividend was up 9% to 9.3p. Basic earnings per share were up 5% to 24.5p. And the underlying basic earnings per share were up 6% to 25.2p. You said the 10% revenue increase was due to customers continuing to upgrade their packages and increasing their use of digital products. 201.7 million of cash was returned to shareholders via buybacks and dividends. However, that is on a market cap of 4.55 billion, so it's not a massive yield. The average revenue per advertiser is up 9% to £1,431 a month. Total memberships reduced 1% to 18,785, with agency branches down 93 or 1%, and new homes developments were down 4% since the start of the year. They've had resilient traffic with a total of 15.4 billion minutes spent on the platform in the year, and that's down from 16.3 billion the year before. However, given sort of what property prices and interest rates have done, I don't think that's massively surprising. Time on the platform is still 27% higher than 2019. They've had a continued uptake in their top packages, Optimizer Edge and 2020 for agents, with 35% of independent agents now subscribing, up from 34% in 2022. Advanced for developers has 53% of developers subscribing, and that's up from 42% in December 22. In terms of the outlook, they've said in 2024 they expect average revenue per advertiser to grow £100 to £110, driven by the new Optimizer Edge package, ongoing product uptake and contract renewals, with overall revenue growth of 7 to 9%. Customer numbers are likely to drop slightly given the ongoing uncertainty in the macro environment. They anticipate an underlying operating margin of 70% in 2024, and it was, I think, about 71% this year. In terms of the valuation, the business trades at a PE of 22.5 and has a yield of 1.64%. As a shareholder, I was very, very happy with these results. I think one thing I like about it is if you compare it to the house builders we've looked at in the last few weeks, it has not dropped off like the house builders have. It's not suffered in the same way because a lot of the agents just have to continue using it whether they like it or not. I think at a PE of 22.5, it's probably among the cheaper end of what we've seen during the time we've covered it on the podcast. I think when it's growing revenue at 7 to 9% next year, it's not a cheap stock, but given it's a monopoly, you do expect to pay a premium for that. I know we covered it a few months ago because you've got the on the market's been acquired by an American rival, but I'm not really concerned about that at all. I think it will keep its monopoly status. So yeah, I'm very happy with these results, and I'll continue to hold it. John, what about you as a fellow shareholder?
Yeah, no, I was like you, happy with the results. Thought they're doing well. I suppose that one of the things that has affected the share price over the last year has been this CoStar acquisition of on the market. I think initially it did come as a bit of a surprise, and obviously a very big player coming in, and big player from the US, which with a much larger market cap than Rightmove. But still, I think we were both discussing it off air previously, and Google and a lot of very big players had looked into the UK property market and basically didn't feel that they could disrupt Rightmove's place in the market. So and with Rightmove continuing to deliver, I'm not unduly unnerved by it. Valuation still on the higher side, but actually it has been coming down a bit. So quite happy to hold. And I think if I were looking at it today and I didn't already own shares, I'd probably see it as a bit more of an opportunity to get in at what is a relatively for the group a relatively depressed price.
Yeah, I think as well, if they can continue growing, I know it's only like 7 to 9% a year, but then because the margins are so high, if they can continue growing the revenue at that rate, the earnings could increase fairly significantly, just because so much of it is flowing through.
That's right.
Should we move on to Haleon?
Yes. So Haleon, we've covered it a few times on the show. It's the FTSE 100 consumer health group that was spun out of Glaxo. So it was essentially their consumer health division. It has brands like Sensodyne toothpaste, Panadol, Centrum vitamins, Otrivin nasal spray, amongst others. It had its full year results out, and the group reported full year revenue of £11.3 billion. Organic growth of 8% reflected increases in all regions and categories. Most of the growth was delivered by price hikes and a much smaller amount, but still positive contribution from volume and product mix. Underlying operating profit grew 10.4% to £2.6 billion, and that was helped by disciplined management of the cost base. And free cash flow came in at £1.6 billion, which helped drive down net debt from £9.9 billion to £8.5 billion. For 2024, organic revenue is expected to increase between 4 and 6%, with higher growth in underlying operating profit. An increase in the dividend payout from 30 to 35% has been proposed, giving a final dividend of 4.2 pence per share. And Haleon now expects to spend £500 million on share buybacks during 2024. And the shares were up 7.7% in morning trading. In terms of valuation, Haleon has a market cap of £30 billion and trades at 16.6 times forward earnings, with a prospective dividend yield of 2%. I thought this was a pretty decent set of results, and good to see net debt falling as well. It's now below the 3 times EBITDA, and they're targeting the 2.5 times ahead of schedule. As we've said it before on the show, when it comes to Haleon, not the strongest brands, still decent, but not the strongest. But it is delivering on what it does have. And I think we've seen with some of the other consumer goods companies, and what we're going to see with Reckitt, this is actually, I think pretty decent. Doesn't make me particularly interested in buying Haleon shares, but I think it's a good performance. The other thing that we would say is that Unilever did try to buy the consumer goods division of Glaxo before it ended up just being listed, and they offered 50 billion quid for it. And even with these results and the group doing well, it's only trading at, has a market cap of 30 billion. So I think that does give you a sense for the premium that Unilever were willing to pay for this business. So I'm very glad as a Unilever shareholder that they didn't. Sam, what are your thoughts on Haleon and these full year results?
I think they're really good. I think the 8% organic growth is pretty good. But to do it with a volume increase, albeit a small one, really, really impressive based on what we've seen in probably the last 2 or 3 weeks, because we have covered a lot of consumer goods companies. I think we've probably done a lot in the last 3 or 4 weeks, it feels like. But yeah, there's not many that have done it. A lot of them have had, what has, like Coca-Cola has. I think there might have been one other that did, but all the others, it had been slight decreases.
Yeah.
I think even Nestle had a decrease, hadn't it?
Yeah, no, Nestle dropped off. Yeah.
Yeah, I think this is really impressive. I didn't expect it, but it is really impressive. I think the main issue for it is, firstly, like you say, I don't think the brands are as strong as some of the competitors. The debt's coming down and that's going in the right direction, but you can still tell there's a lot of debt just because that I think the debt's now 3x the profits, which isn't terrible. It's not at a point where you'd be concerned for the company, but it is having a serious impact on the dividend because
Yeah.
the dividend's only 2%, and that compares to like 4 or 5 for competitors. So I think really good year it's had. They can't help the fact they've been spun out of all this debt, and they, in their first year, I think they've done really well. I think they just need another few years of putting up good results, paying down the debt. And I think we could be sat here in sort of 3 or 4 years' time, and it's a very different conversation because all of a sudden, if they've got 3 or 4 years of delivering these kind of results, and on top of that, the debt's come down significantly, it's all of a sudden at a 4% yield. I think you'd take a more serious look at it compared to some of the others. Like, I think it's like at that point, it's like there's a serious discussion to be had. Would you buy it over Reckitt, for example?
Well, yeah.
Whereas now you
yeah.
just wouldn't, because I think mainly because the brands aren't quite as good. But I think the main issue is just that yield is so low because of the debt. Yeah, I think it's a really, really good first year as an independent company.
Yeah, no, absolutely. All right, on to our second REIT of the week.
Yes, so Tritax. It's one we haven't covered for a while. Did we have it in the fantasy portfolio at one point?
I feel like possibly. I know we had
Maybe.
Segro, which we
Potentially.
covered. Yeah, but didn't
not
leave
sure.
the mark.
Yeah, we definitely covered it before. So Tritax, for anyone who's not aware, because I think it's probably been at least 2 years, they are a real estate investment trust and they generate income by renting out large warehouses, which are central to modern logistics and e-commerce. So it's like when you see the massive Amazon distribution centers, those are the kind of buildings they build and let out. So as you can imagine, they did very, very well in COVID. And I think they've come back down quite a lot since then. The strategy has slowly been shifting towards smaller urban logistics centers that offer better yields. And they've come out with their full year results, and they reported a 7.8% rise in net rental income to 222 million. Acquisitions, developments, and rent reviews all contributed to growth, offset by disposals, and operating income rose 5.5% to 193 million. Portfolio value was broadly flat at 5 billion, and occupancy was 97.5%, and that's down slightly from 97.9% a year ago. The portfolio loan to value was 31.6%, and that was up slightly from 31.2%, which it should be noted that's significantly lower than sort of the 50% we saw for primary health properties. Interim dividend of 2.05p was announced, taking the total to 7.3p, and that's up 4.3%, and that is on a share price of 149.7p. Build costs are easing, and this is expected to support development yields in 2024. And they have a proposal currently in place to buy UK Commercial Property REIT in an all-share offer worth 924 million. And they had until actually 9 p.m. yesterday to make a firm offer. The deadline has now been extended to March 22nd, and the shares rose 2.1% in early trading. It's worth noting, if the acquisition of UK Commercial Property REIT does go through, there would be some complementary assets. However, about 40% of their portfolio isn't in the industrial space. So it's stuff like retail parks and offices. So it's not clear what they'd plan to do with that, and whether they plan to just get rid of it or keep it and diversify. In terms of the valuation, business trades at a forward price to book ratio of 0.82, and that compares to a 5-year average of 0.9. The prospective yield for the next 12 months is 5.3%, and that compares to a 5-year average of 4.4%. And they're currently trading at a 20% discount to the net asset value. I wouldn't get too excited about that because REITs typically do trade at a discount to the net asset value. I think this is a business that I like. I think they have a lot of long-term tailwinds in their favor, which is partly why we saw the spike that we did. Yeah, so pre-COVID, they were trading at a similar price to where they are now, and they went up over 50% during COVID. And then they've just slowly dropped back down. But yeah, I really like the industry. I think if I were to get a REIT, Tritax would be the one I wanted, especially now the prices have come back down again since we last looked at it. I suppose this is offset in that I think their properties are probably more likely, because it's the big sort of distribution centers and stuff, I think their properties are more likely to increase in value than maybe the primary health property ones. So you do have that potential for capital growth. But for a REIT, really, they never reinvest in the earnings. because they have to pay to retain their REIT status and
Yeah.
not pay corporation tax. They have to pay 90% of them out. So that's why you get such good yields on them. But you're talking about a prospective yield of 5.3%. And it's the same argument with primary health. I think there's better potential for capital growth. But in terms of the income, you can basically get that in a bank now.
Yeah.
So I think to actually see it, I suppose that's maybe reflective of just how potentially valuable the underlying assets are more than anything else. But in terms of the yield, I actually think that 5%, 5.3% is pretty similar to where it was pre-COVID, and the interest rates were a lot lower then. But that being said, if I did have to have a REIT in my portfolio, Tritax is the one I would get, and I do like the industry. What about you, John?
Yeah, no, I do like it, and I think it was a decent set of results. I was going to put to you, Sam, what would your thoughts be comparing Tritax to Segro?
I don't really look at Segro regularly. I know we covered it a few weeks ago, but that's like the first time I've looked at it in 2 years. I followed Tritax slightly more closely, but even then I've not looked at it for a couple of years. I'm just not up to speed in it. I think partly the reason that Tritax would be my choice is because I don't follow many of them. So it might be that if I actually dug in and looked, I'd prefer Segro anyway.
No, fair enough. Because that was the other thing. Because I think, what did you say the market cap was? About 2 billion.
2.8 billion.
2.8 billion, okay. And I think Segro is about 12 billion. So there's quite, I guess, a size difference, but it's a similar industry. Yeah, no, it's interesting. I think we might need to compare the two directly next time. I think that'll be interesting.
I'd have to have a proper look at Segro because I don't know it well enough is the problem.
Yeah. No, absolutely.
Should we move on to a business that we do know quite well by now?
Yes, unfortunately. So it's Reckitt Benckiser. They are a FTSE 100 listed consumer goods company, covered them many times before. They own brands like Nurofen, Durex, Dettol, Finish, Lysol, and quite a lot of others in sort of kind of consumer health as well. They had their full year results out last week, with the group reporting full year underlying net revenue of £14.6 billion, with like-for-like sales growing 3.5%, which was below market expectations. Volumes were down over 4%, and growth was mainly driven by price hikes. By business unit, hygiene and health was more than offset by weakness in the nutrition division. Underlying operating profit fell by 1.9% to £3.4 billion, and free cash flow increased from £2 billion to £2.3 billion. That was mainly due to the timing of certain payments. The net debt position improved to £7.3 billion compared with £8 billion in the prior year. The group is targeting like-for-like net revenue growth of between 2% and 4% in 2024, and those expectations include mid-single digit growth in the health and hygiene and mid to high single digits decline in nutrition. The board has recommended final dividend of £1.15 per share, and the shares were down nearly 10% in early trading. In terms of valuation, Reckitt has a market cap of £36 billion, and it trades at 16.7 times forward earnings, compared with a 10-year average of 19.8, and it currently has a dividend yield of 3.5%. I think these results are really disappointing, particularly with the brands that Reckitt has in its stable, and it really should be doing better. There have been plans for sort of turnaround for years and years and years. I bought shares back in 2018, and I think it's just been disappointing, with the exception of COVID, where obviously hygiene got a massive boost. I think it's been very disappointing ever since. I've never really seen things turning, so I did sell my shares last year. There are things to like, which are really the core brands that it has, but it just hasn't been delivering on it, and it's difficult to see who and when that is going to be changing. Obviously, when they brought heavily into the nutrition business, that had done very badly, and they'd massively overpaid for that, and then subsequently offloading a lot of it. But just a company that's been underperforming for a long time, and I thought there were better opportunities elsewhere. We've seen with Haleon, despite obviously it being loaded with debt to start with, as it was spun out, it's beginning to deliver. But then you compare it with the Reckitt results, and they just are really disappointing. And I think even, Unilever, another competitor, doing much better, and Reckitt is the sort of the laggard in that sense. So yeah, I don't have a lot positive to say about it, and nor do I think it's particularly cheap either. Sam, what are your thoughts on these results from Reckitt?
I completely agree. I think these results are really bad compared to what we've seen in the last few weeks. I think the only company we've seen in the same industry with worse results is PZ Cussons. And PZ Cussons' biggest market is Nigeria. So
Yeah,
they've mainly suffered from currency devaluation. But other than that, by far the worst performer.
yeah,
The volume growth is really poor. And then it's not even like they've increased the sales that much. It's an absolute shocker. It really is.
yeah,
It's by far the worst set of results I think we've seen since we started covering them. And then I agree with what you say as well. You look at it and it's trading at a similar PE to Unilever. And I just think, who's buying this over Unilever with these results? It's
yeah,
just
yeah,
not really anything else to say on it. They're just absolutely really poor. And I don't understand why it's still valued so highly.
yeah. No, I completely agree. And I was, I've been glad that I sold when I did. I just be interesting to see whether anything does develop. I'm just more relaxed now that I'm not a shareholder and we're covering it than when I was, because it continued to disappoint.
Yeah, they're the worst set of results, like I say, apart from PZ Cussons that we've seen from the consumer goods companies in the last month. Really, really disappointing.
Yes.
Move on. Something more
Yeah,
positive.
yeah. So how's Etsy doing, Sam?
Etsy, I think they're doing well. I am a shareholder. I am biased. So Etsy have come out with their Q4 and full year results, and consolidated gross merchandise sales, which is the total value of everything they've sold on their platform. That was $4 billion, and all these figures are in dollars, and that was down 0.7% year over year and down 1.6% on a currency neutral basis. They've said that headwinds to this included a dynamic macroeconomic environment that impacted consumer discretionary product spending, category mix as well, a highly promotional competitive retail environment, and a small headwind from the divestiture of LO7. They had a small investment in what was hopefully going to be the Brazilian Etsy. That's not really worked. They've got rid of it, but it was pretty small anyway. I don't really have an issue with a 0.7% decrease in the gross merchandise sales, just because I think when you look at the year we've had with like cost of living crisis and stuff like that, Etsy is mainly gifts. It is purely discretionary spending. So I think I actually think that's not bad given the year the economy's had. The marketplace gross merchandise sales accelerated during the holiday season, with gross merchandise sales during Cyber 5, which is Thanksgiving through to Cyber Monday, up 4% on a year-over-year basis. Record levels of gross merchandise sales on Cyber Monday and Giving Tuesday. Didn't know about that one. Active buyers reached a new all-time high of 92 million, increasing 3% year over year. United States active buyer trends continue to improve, with modestly positive year-over-year growth again this quarter, and international buyer growth remains strong. Reactivated a record nearly 10 million lapsed buyers, up 13% from the prior year, and acquired over 8 million new buyers. On a trailing 12-month basis, the retention of active buyers improved from the prior year and remained above pre-pandemic levels. And the take rate was 21% for the year. So the revenue, that was up 4.3% for the final quarter and up 7% for the year as a whole. So although people are buying slightly less on the platform, their take rate has actually gone up by a fairly decent amount. And that's split by marketplace revenue, which was up 2.6% for the quarter and 4.5% for the year, and services revenue, which was up 9.4% for the quarter and 14.6% for the year. And marketplace revenue for the year made up just under 2 billion, and services revenue was 750 million. Gross profit was up 0.9%, very slightly for the quarter, and 5.4% for the year. And operating expenses were up 6.6% for the quarter, but down 33.9% for the year. And there was a net income margin of 13.6% for the quarter, but negative 27.1% for the year. I don't think we need to worry about that. We'll get to it when we cover the cash flow. But the main reason is in the height of the pandemic, they bought a few acquisitions, all of which have done pretty poorly. They partly paid in overvalued Etsy stock, so it's not too bad. But this net income loss is basically impairment. So they've written off basically stuff they overpaid for a few years ago. But in terms of the cash the business is doing, it's actually doing pretty well. They've said that For the consolidated gross merchandise sales of 13.16 billion, that includes 11.6 billion from Etsy, 942 million from Reverb, 599 million from Depop, and 42.1 million from LO7, which they sold on the 10th of August 2023. And the percentage of gross merchandise sales from US domestic was 47%. And they've said the net loss for the year is driven by the Depop and LO7 asset impairment charge of $1 billion. There were quite a few interesting points in the slides. So the consolidated free cash flow was 665.6 million, and that's on a market cap of 8.56 billion, which I'll get onto a bit more when we do the valuation. They've highlighted that buyers are spending more on Etsy, with the average buyer spending $126, or the average active buyer spending $126 in 2023, and that compares to $103 in 2019. 48% of buyers are repeat buyers, and that compares to 41% in 2019. The total number of active buyers is up 101% since 2019. Total habitual buyers, so I think habitual buyers are the buyers who've spent $200 or more and made purchases on 6 or more days in the previous 12 months. They're up 184% since 2019, from 2.5 to 7.1 million. The average US consumer spends $1,600 a year on gifts, and the average annual Etsy buyer only spends $38 a year on gifts. And only about 10% of US buyers spontaneously think of Etsy for gifts. So I think in terms of the total addressable market, I actually think they could have a lot more of that market, because I do, as a user, I do think it's a great platform. And on average, they've used over 60% of the free cash flow from the past 6 years for share repurchases. In terms of valuation, the business trades, well, the PE is really pretty useless because of that impairment charge. But in terms of the free cash flow, it's only trading at 13 times free cash flow. Over half the free cash flow is being used for buybacks. That does give a pretty decent yield. I actually think these are a good set of results. I know the gross merchandise sales are down slightly, but I think given the year we've had economically, I don't think that's that bad. And I think if you look at a lot of the underlying metrics, like the user growth, the habitual buyers, the amount buyers are spending, they're all moving in the right direction. So I think they are putting a good foundation in place that I do think in the long term, it's a business I really, really like. To the point where it's hard because I am biased, because it is one of my biggest holdings, but I do find it really confusing why the price is so low. I was wondering today if part of the reason could be that because of the impairment charge, are people not really looking beyond the PE ratio. So the minute it's got a PE of about 32, but it's only 13x free cash flow. That cash flow, if you look at historically, it's pretty sustainable. Pumping it into share repurchases, I think this is a really, really good year for Etsy, given the environment they've been operating in, and I'm really happy with it as a shareholder. I'm probably very likely to add to it actually on the back of these results. John, what do you think as someone who's slightly less biased?
No, I would generally agree with you, and every time we cover it, I say I've always liked it, but it's been the valuation, and particularly over COVID times, that was certainly something. And I don't know what it peaked at. It's about sort of $70 a share at the moment.
It is, yeah. I think it was over 300 at one point.
100, yeah. So it was absolutely insane. But it's kind of one of those Peter Lynch stocks, and I think the fundamentals are pretty solid with it. I'm very close to buy it, starting a position in it, because I don't currently own any Etsy stock. And all the companies that we've covered probably for the last 6 months, Etsy is the one that really does stand out for me, and particularly from sort of the valuation of it as it currently stands. And I would agree with you in terms of how to interpret those results. And yeah, the PE metric, obviously not being really applicable at the moment. So yeah, I do like it a lot.
So of the 6 businesses that we've covered this week, then Primary Health Properties, Rightmove, Haleon, Tritax Big Box REIT, Reckitt Benckiser, and Etsy, which one do you like the most and which one do you like the least?
I would go for... It's a tricky one. I like Rightmove a lot. I own Rightmove already. Of the ones, as I don't own Etsy, I like it a lot. That would probably be my top choice. In terms of what I like least, that is tricky. It's between Reckitt and primary health properties. I would probably go with primary health properties that I like the least, but Reckitt is certainly in my bad books at the moment.
I think for me, it probably, there's two companies I own in here, in Rightmove and Etsy. I think for me, it would probably be Etsy. I think I probably am going to add to it in the near future. Of the ones I don't own, it would probably be Tritax Big Box REIT that I like the most. In terms of like the least, I think the results were that bad. It would actually, I feel like it would be unfair to put anything below Reckitt.
Yeah.
So I'd probably give that like the least, because I just think the results were so poor.
Yeah. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.